Hi everyone. The event will begin shortly. We will wait for all our guests to join the event and we'll be right back with you. Thank you. Hello everyone. Good morning, good afternoon, and good evening. My name is Ekant and I would like to welcome you all to another edition of KiwiTech's Angel Investor Panel today. So today we have a fantastic panel discussion on early stage valuation. This is valuing early stage startups and the methodologies that angel investors can employ, followed by 6 high-value growth stage startup presentations. I'm joined by my colleague Shubha Mohan, and the two of us will serve as the moderator for today's event. So let's get started with a brief introduction now to KiwiTech, followed by our angel investors panel. So it's my pleasure to introduce KiwiTech. It's a one-of-a-kind innovation ecosystem that's home to 500 plus portfolio startups and 300 plus mentors. Everybody committed to supporting innovators globally. And this all began in 2009 when a team of seasoned entrepreneurs who had previously built and scaled a publishing services company for a 9-digit exit decided to start another company. And was to empower startups with innovation. So, all in all, we at KiwiTech particularly team up with early to late stage startups to support entrepreneurs with 360-degree support in terms of technology, fundraising, mentorship, networking opportunities, and go-to-market strategy. And you know, without further ado, I would like to introduce our panel moderator for today, Ike Syed, who is the SVP Strategic Partnerships at KiwiTech, to start with a panel discussion. So over to you, Ike.
Thanks for that, Ekan. Can you see me and hear me clearly?
We can see you and we can hear you, Ike. Nice to have you here.
Wonderful. Great to be here. Well, good morning, good afternoon, good evening, folks, depending on which part of the world you are dialing in from. As Ekan said, my name is Ike. I'm the SVP of Strategic Partnerships based in the Washington, D.C. area. Super excited to bring this angel investor panel discussion to you. I'll be joined by Brian over from Blue Ventures, company based in Washington, D.C., and Philip from Gangels, an investment syndicate based in New York. We'll be talking angel investing. We'll be talking about valuations happening in that space, industries that are of focus now, what's happening in 2023 and beyond, international investments. So sit tight. This will be a fantastic discussion. If you have any questions, feel free please feel free to post them in the Q&A window as well as the chat window. Nothing is off limits when it comes to angel investing. Again, these folks have been doing it for a while. KiwiTech, we are also very active investors in the angel space through our services model. So, with that, I will just kick it off. Brian, Philip, if you can turn your video on. And then for a brief introduction, let me start with Brian and then go to Philip next. Brian, if you can share a little bit about Blue Ventures, what you do there, what the firm does, that will be great.
Sure. Blue Ventures is a 13-year-old venture capital firm based in the Washington, D.C. area. Investment-wise, we focus on U.S., Canada, Australia, and Western Europe as well. We have 4 different funds. 2 of them are focused on more general B2B software, but with a focus on health tech and fintech. And then we have 2 additional funds that are focused exclusively on cybersecurity. I specifically help to invest in our seed stage cybersecurity portfolio. So what that looks like is typically companies that have traction somewhere post MVP from a technology perspective, with a couple interesting beta customers and design partners, all the way up to about $700,000 of ARR. We are, as a firm, comfortable with just about any type of investment security. So safe notes, convertible notes, price equity rounds, and we're also comfortable with leading, co-leading, or following in investment rounds. It really just comes down to the economics of the round. And if our check size is able to designate us as a lead or a co-lead. From a check size perspective, we typically invest between $100,000 and $250,000 per check for our cyber seed fund. For our Series A fund, for cybersecurity, check sizes are a little bit larger, generally between $1 million and $4 million. And for traction for the Series A as well, usually like to see at least $1 million of ARR.
Wonderful. Philip?
Hey, thanks for having me. Gangels is the world's most active venture syndicate that promotes access, visibility, and representation for underrepresented folks in VC. Last year, we were ranked 9th most active syndicate in the world by PitchBook, so very happy and proud to be part of that organization. We primarily run and manage SPVs for our LP network, so a syndication model. We do have funds that we run and manage for those LPs as well. Those are rallied around vertical industry focuses like enterprise tech, health tech, AI, and fintech. But I myself work under the AngelList side of our business, where we run and manage both syndicates and funds. Very happy to sort of be here. I would say our check sizes are not in the lead category. We're much more of a strategic ally for folks. Those ranges from $100,000 to $250,000. The fund checks are a similar size in the $250,000 range. And I would say that the primary driver of our business are those SPVs. Since I personally started, I've had a hand on the AngelList side and over 2,000 transactions and about $400+ million invested. So I'd say that we leverage a volume-centric model in what we do with the theme of diversity, equity, and inclusion. We're industry agnostic in our focus, although technology, of course, is the primary focus and driver of what we're interested in. And because we're a syndicate, our thesis, I would argue, is a bit more flexible. We're more responsive to the interests and whims of our LPs more than any sort of defined thesis of what we're looking for. So to me, that makes my job a little bit more interesting and exciting. But we certainly focus on exceptional founders, sizable market opportunities, and strong product market fit to start.
All right. Wonderful. All right, great. No, I think this is wonderful. 2 fantastic panelists coming from different parts of the country and having different areas of focus. So this should be a wonderful discussion. Let's dive right into it. Angel investing has been really tough over the last 1 year, especially companies who are looking to close around. Obviously, angels by definition are less sensitive to valuation, but at the end of the day, whether it's a safe note that you go in with or a convertible note, there's obviously some sort of evaluation that has to be done, whether it's on paper, whether it's internal within the partners. I'll post a link here. This is a news from Michigan earlier this year, just describing kind of what happened with a 29% drop compared to 2022. It was from a few months ago. So now as we head into the end of the year, Philip, let me stay with you. What are you seeing in terms of valuations, in terms of deal flow? Are you guys, kind of more busy, given that there are a lot more sweet deals to be had and bargains to be made? Or are you also shying away, kind of seeing what's happening with the rest of the industry?
I think it's a great question, and I think the answer is actually both. Our deal flow has remained consistent. As you mentioned, in a down market, there are really attractive valuations that we're seeing across the board in industries, because founders are feeling that downward pressure from investors to make their valuations a little bit more attractive. Obviously, risk capital is very hard to come by these days. So for us, it benefits us from the attractive valuation standpoint. But us as Angels, as a syndicate, we're beholden to LP appetite and interest. And as you mentioned, it's been a very long year because folks are just less willing to commit capital to things. That to me means that better deals are rising to the top. So the opportunities that we're assessing are of higher quality. But still, it has certainly been a uphill battle, shall we say, in convincing folks of accurate value for what they're investing within. I think that I can speak personally to the AngelList platform. The volume of commitments is down 80% year over year. So that kind of gives you an idea of the scope of decrease from the angel side of things in venture over the past year. You've also seen a significant drop down in median valuations across stages. I think most particularly the Series B stage was hit hardest. I think 2021, 2022, you would see an average of about $160 million for those kind of rounds, and that's more in like the $90 or so million. So there's been a stark drop off, but as you're saying, Ike, I think it also provides an ample sort of opportunity for really attractive valuation investing, getting really good deals on not only really nice and exciting emerging companies, but existing companies that have proven business models, really strong business foundations that you can kind of double down on, and prices that are, let's say, half off of what you would have seen in 2021.
Got it. Brian, in the area of cybersecurity, I'm curious. Obviously, there was the hack at the biggest bank in China. I think it was like earlier this week or last week. Again, are you finding similar trends, given that that's where you focus on, cybersecurity seed, or is it more counter-cyclical? Kind of what are you seeing there in your space?
Sure. We've seen fairly consistent demand across the board for capital. Earlier in 2023 and really later 2022 as well, we just didn't really see a strong match of valuation expectations from founders with what the market was willing to pay. So for us, there was a fairly extended period where it was difficult to come upon companies that we were interested from a team and technology perspective, but also had strong valuations that aligned with our partners' expectations regarding valuation. So there was a while where we held tight, wanted to be very valuation focused, make sure that we were not overpaying for the opportunities. So we've kind of seen that change a little bit now since September. So we've been very busy since September. Right now we have 5 deals in due diligence at the seed fund. So, moving along very quickly, we've seen a little bit more of a realistic match for, valuations, but I think also, to some degree, founders have just really started to need capital. When before it was, raising for somewhere between 24 and 36 month runways, we're now seeing slightly shorter runways and more realistic burn expectations. And I think that is also, being driven by just the shorter, the less demand for capital, or demand for capital from the actual LP side, being able to drive that into companies due to higher interest rates. But, we're also expecting to see that continued decrease, hopefully in valuations. During most of 2023, we actually saw valuations at the seed stage for cybersecurity companies increase, as opposed to decrease like we've seen across most other industries and also most other stages, which we found to be pretty interesting, not something that we expected. But we have seen some of that valuation come down from founders, but also founders being more open to different types of structures, for example, providing some performance-based warrants as well, which has helped to give our partners a little bit more appetite.
Got it. And I just realized the link I shared earlier about this between the three of us, so I shared it again with everybody, the entire audience, as well as the second link I was talking about with the ransomware attack on the ICBC, as well as the potential fallout in U.S. Treasury market, and the pretty much the entire financial system. So that's obviously very much of concern. So good. Heading into 2024, and Brian, let me stay with you. Any specific areas of cybersecurity where you see a larger uptake, whether it's on the terminal side, the enterprise infrastructure, more on the data processing and storage? I'm curious, any specific area of cybersecurity which you see kind of an uptake, or again you see a nice growth across the board? And I do see there's questions starting to come in from our audience. But Brian, why don't we go into that question and then we'll start going into the audience questions. Go ahead.
Sure. Yeah. So as a fund, we do have a fund mandate that we're not allowed to invest in direct competitors within our portfolio. And that's kind of one reason why we're a little bit more cybersecurity agnostic. So not necessarily focusing on just 2 or 3 sub-industry verticals. Second reason is, to be honest, I think there's a lot of challenges still within the cybersecurity industry and ecosystem that need to be solved. Don't think there's going to be, one cure for all of them. So we are trying to diversify across, many different types of sub-industry verticals. However, there are a few that we've seen be within high demand, not only from investors, but also, from the enterprises that are looking to purchase those services and, tools. So one of them is application security. Another one is software supply chain security, which is a generally newer area within cyber. And then third, as well as you mentioned, infrastructure is starting to additionally pick up. So that one's interesting just since a lot of the technology and systems within infrastructure, aren't able to be updated as easily and as regularly. And, certainly can be an area of large vulnerability for companies that are, very infrastructure heavy and have, pieces of technology installed upon those systems. So those are just, a few areas that we're looking at and expecting to, upswing in 2024 and 2025. However, there are still several areas, and we feel that, across the board in cybersecurity, there's going to be continued demand as we're just seeing more and more breaches, more damage done per breach. So definitely overall cybersecurity seems to be a strong industry for the next 3 to 5 years.
Got it. Philip, same question to you, and maybe even more applicable given that you are sector agnostic. So you look at everything with obviously the strong focus on the equity and inclusion. But any thoughts on industries that you think you'll focus on in going into 2024 and beyond? Any specific sectors?
Absolutely. Again, so as a syndicate, we're kind of responsive to LP demand, and I think that demand is oftentimes derived from what they're reading in the newspapers. What generally in the broader discourse of technology and innovation is happening seems to be the exciting kind of hot button industry of the moment. So for us, we've of course invested into a lot of enterprise and generative AI companies most recently. We have a lot of sort of faith in the space. I personally would argue things like OpenAI may have reached peak valuation, but there are so many excellent, really early stage companies that are coming out right now that are offering, whether it be picks and shovel plays for infrastructure that'll support AI moving forward, or for really, really creative solutions in enterprise spaces for business optimization, enablement. Consumer side, Humane AI, I don't know if anyone saw the demo recently. That's one of our portfolio companies. There are some really exciting applications on the consumer side for that as well. So we're very bullish. Although I will say, obviously, as any sort of VC wave comes, it also crashes. I think last year there was the Web3 crash. The year before that, the crypto crash. So as an angel investor, you have to be very conscious of really getting strong valuations for what you're investing in. For us, that lets us kind of have a bias towards earlier stage companies where those valuations by nature are going to be a lot more attractive and a lot less, large. Like, OpenAI, I think was at 90 billion most recently. That for us is just way out of the ballpark. But that I would say is our current primary focus. Again, we're at the whims of folks who are interested in exciting things going on, and that just feels like a very hot button sort of buzzword for them. We still certainly have a lot of holdings in any sort of generalist enterprise B2B SaaS offerings. Brian, we also certainly, as you're mentioning, have interest in the cybersecurity space. That's definitely something that, as we grow the software reach, so does the need for cybersecurity solutions. So that is a really strong and safe bet in the long term. We've certainly seen a reduction in interest in things like health tech, biotech, and fintech. I think that's a result of 2021 valuations being so ridiculous and remarkable that people just have a shall we say, bad taste in their mouths from what they may have lost in those initial positions. But yeah, I would say, from an industry agnostic perspective, with the technology focus here at Gaingels, we're definitely most excited about, Gen AI and enterprise AI solutions. I will add one note. So I know Web3 feels like it fizzled and kind of down the vine, which may be true for a lot of applications from the consumer perspective today. But I will say we still have a lot of faith in longer term applications of those technologies, whether it be through blockchain, securitization, digital asset share from a consumer standpoint. And we think that today, given that there was a backlash, shall we say, from the market against those hyperinflated valuations in 2021 and 2022, we're seeing a lot of good value for money today in those same enterprises. So yeah, I would say the focus here is at least at Gaingels in the AI and Web3 space.
Got it. Okay. All right, Philip, let me stay with you. Want to turn my attention a little bit towards international investments and maybe just a yes or no questions. But we have our portfolio companies pitching today from the Middle East, from Canada. Do you look at companies outside the US? I mean, and given that typically they might not have a Delaware C Corp structure, is that something you're still open to or not really?
Absolutely. Gaingels is focused on DEI, so you could apply inclusivity to our investment strategy. For us, if the founder is exceptional, if the market opportunity is exceptional, then we're willing to do it. I can speak from the angel side of the business. For us, if a company is incorporated non-locally, there's an additional fee on the SPV management for that opportunity. I think in the nominal, maybe $1,000 an opportunity kind of size. So for us, it's not a very strong consideration. Obviously, if you're a company based internationally and focusing on international markets, there's a different valuation because there may be a more limited market opportunity available. There may be differing qualities of existing infrastructure that can enable any kind of growth strategies. So for us, we certainly look at those opportunities, not with a grain of salt, but with an added sort of, inkling to what the context of that marketplace looks like. But I would certainly argue that international investment has, steadily increased. VC visibility in international markets has definitely increased. Gaingels, through our network, has certainly created a more LATAM, shall we say, focused, a broad perspective in what we're looking at, whether it be through members or opportunities. I think there's great value for money abroad. I think that the US market, because it is the by and large most expansive opportunity available, it comes with a hefty tax on that. By rate of success, there are obviously a lot more unicorns in the US than there are elsewhere. But you could take a few small swings and get 1 or 2 home runs in the international market that you otherwise wouldn't expect. And I can certainly speak to our investors coming from international disposition and wanting to invest in their own local communities. So we're certainly interested in that, and I think it actually makes sense from a valuation standpoint as well.
Got it. So do you require your portfolio companies to do something like a Delaware flip, or as you mentioned, it would just be an additional cost on the SPV, as you mentioned, and that's good enough? You would not require a Delaware flip?
So most often we don't require a Delaware C Corp flip. We understand that that's sort of very expensive oftentimes for companies to do. And for us, if it, factors into an additional, thousands or dollars on the management fee, it's kind of negligible for us if we want to really contribute and maximize our investment there. I will say though, of course, unfortunately, we are US-based VC. The majority of our syndicate members are US-based, and so their bias and their interest will oftentimes lie in the US market. So at least from our own perspective, our own network, if you want to come and have this really interesting and exciting international facing business, I would strongly encourage you to really emphasize the strength of your business fundamentals and your sort of optimism for what will come within your marketplace, because I think folks may generally look at those opportunities with an additional layer of scrutiny, shall we say, because they're not US based.
Got it. Got it. I mean, it does provide that nice diversification, but obviously you got to weigh like what kind of costs and obviously regulatory opens. So absolutely. Brian,
Absolutely.
Brian, what about you? Open to international or not at all?
Yeah, absolutely. So we are, mostly US invested. We do have portfolio companies as well that are based in Canada, Australia, also interested in Western Europe as well, and Israel. As Philip noted, there are definitely some strong valuation discounts typically as compared to US markets, which is obviously great for IRR returns, etc. So certainly open to it. I think what we find on the cybersecurity side is the US has one of the most, if not the most, developed cybersecurity industries within the world, not only from a technology perspective and services, but again, as you would see, also valuations as well being higher. So, while we are comfortable investing in other countries, we do see sometimes that those cybersecurity companies from other countries will typically lag a little bit with the development and maturity from a technology perspective, which can be challenging at times as well. A lot of them are trying to enter the US market. So from a competitive perspective, can be slightly challenging if they need another year in order to fully develop their technology to be as competitive with similar tools on the US market. And then additionally, kind of talking about the Delaware C Corp, from a legal perspective, we do need our portfolio companies to shift over to a Delaware C. And also something that our partners think is important is having, generally relatively easy access to the founding team. We are very mentor focused. So we really enjoy meeting with the founding team, being a part of those board meetings, being able to provide mentorship along that growth path. And if there are founders that might be based in Western Europe or Australia, while it can certainly work via Zoom, being able to meet in person is also really important, and that can just become a little bit more challenging at times when, again, founding teams are further away from kind of our East Coast base home.
Got it. Okay. Let's see. So switching back to a bit more of a generalist trend, and Brian, I'll stay with you. What's your approach to kind of due diligence as you work with these companies heading into 2024? Do you see that changing in terms of maybe the criteria or the weightage? Maybe the founding team becomes more important versus the revenue, or some other metric you see now changing, or you're like, nope, it used to be X and it's going to continue to be X as we head into 2024.
Sure. Yeah, I think that was something that we found to be important, especially over the last 12 months, 18 months almost, when valuations were peaking, not really seeing a drop back down. We have something, kind of an approach to due diligence, kind of high level, we call the 5 T's. So it's team, technology, traction, TAM, total addressable market, and also terms of the deal. Those are kind of the 5 kind of core areas that we focus on when we're both, sourcing, but then also going through the due diligence process. So, team still continues to be number one importance to us. Obviously need to have a strong team that's going to be able to execute on plans, really to grow and thrive within the industry. So it's still certainly very important to us. Ideally like to have individuals with strong backgrounds in cybersecurity, have experienced prior exits as well, if possible. And then also, something that we like to find is it doesn't have to be just one individual, it could be a couple individuals, but people on the founding team that are both a hacker and a hustler. So hacker from the standpoint of being really strong technologically, and then hustler from the standpoint of how can they be very successful at selling, and do they have a strong track record of founder selling? So those are definitely very important to us. Technology, definitely need to have a strong technology product that is either revolutionary, it's going to be a dinosaur killer, or it's just filling an unmet need. And then certainly the addressable market falls into there, but I would say traction and terms are also very important. If the terms just aren't going to work out, our partners typically walk away from a deal. And then from a traction perspective, we can generally get comfortable at a range. So as I mentioned a little bit earlier, kind of post MVP, minimum viable product with a couple interesting beta customers all the way up to 700,000 in ARR. And I think kind of terms will adjust as well as we see higher traction, typically higher valuation as well. So I think that's kind of our core emphasis on how we will do due diligence, really what we'll start to be looking at as we're going through that due diligence process. And kind of, I would say at least team is probably about 60% of what we're looking at, and then a different smattering of the rest.
Philip?
Yeah, I would say we're similar. So because we're industry agnostic, I think we're able to kind of rid ourselves of specific benchmarks or numbers that we may be looking for in a particular opportunity. Not to say that we don't, for terms, for example, compare it to average valuations we've seen across the board in that specific sector to make sure that the valuation is reasonable within the context of the current market. But we're early stage investors as well. So I think Brian is absolutely right. Team is the most important part of the equation. Ideas are very cheap. Execution is what counts. And backing exceptional founders is the most important way that you can kind of guarantee returns on your venture capital investments. For us particularly, from a diversity, equity, inclusion standpoint, we want to prioritize representation of folks who are otherwise underrepresented. So that's an additional key point for us when we think about team. But yeah, really prior experience, whether it be operating or fundraising. Specifically, Brian mentioned prior exits. That's a really big signal for us as well. We love seeing that founders have done it before, not just from I made a business and I ran it, but also from made a business and had a successful venture exit with it, because that's an entirely different process involved as it relates to the success of a startup. We also, from our perspective, want to make sure that the market opportunity is sizable enough for us to see potential outsized returns on an investment. Every day on my desk, I see companies that are addressing a very interesting market need, but it's remarkably niche. And so for us, when we think about time spent and resources expended on a particular opportunity, we would rather focus on the big and brash and bold ones that could provide that outside return. When thinking about terms, that's an interesting question, because for us, obviously we're sensitive to price, and anything that feels too expensive, we're not really interested in. But I think another portion of the terms that we really focus on, because we're a syndicate, is the co-investor participation. Fundamentally on AngelList, you're sending out opportunities to LPs on a daily basis who may otherwise be members of other syndicates or be receiving multiple communications a day. And so whatever you're sending them, you have to make sure you are solidifying their attention from the get-go. And so for us, if we can say that someone like Khosla or A16Z or whoever else in that sort of top quartile of VCs is also participating, that's a remarkably strong signal for us to project to our investors on a particular opportunity. That also ties into our diligence model. We're volume driven. As I mentioned in my introduction, I've been here for almost 3 years now. That's been almost 2,000 transactions on my team of 2. So we don't have the resources or manpower to do that really deep, in-depth, founder-led diligence. We're looking at other folks involved in the deal to say, hey, listen, Post is in here. That's a really strong signal. We understand that their data requests are remarkably intensive. They've done their research. They've got 20 analysts on their team to do it for us. Not to say we're copying their homework by any means, and we do have a diligence process, but it allows us to sort of work through that volume-driven model a lot more efficiently. I will also add to that, product market fit is very crucial. At the earlier stage, it's very hard to assess that. So, it's not the be-all, end-all. But, if we're looking at traction, I myself always want to look at retention and NPS scores, like understanding how people are reacting to the product this company's putting out. I think at the beginning, it's founder-led sales is most crucial, and then product is second most crucial, and really, really, really hammering in what is the most, sort of sellable and exciting and engaged part of your product and focusing on that. So If a founder comes to me and demonstrates that they've identified that specific niche of their product and are really hammering down on it, then I have confidence that he understands what that journey is supposed to look like at the beginning. And then, I mean, product obviously is very important. Disruption is very important. Disruption is what leads to those unicorn type companies that are fulfilling an unmet market need. So that, while difficult to quantify, can sometimes be a bit easier to qualify, because you usually kind of feel it on a pitch. You sense that what they're talking about feels remarkably unique, not done before, and super exciting. Sometimes it's hard for me to kind of keep my emotions in check when I do experience that. Yeah, I just, team is always first. Product market fit's important. For us, institutional participation is super important. We get to have a more holistic approach to it. And we're not lead investors. So for us, we're not setting terms, which I think removes a bit of the pressure from our standpoint of fully assessing, projected performance and things like that. We're really looking at the company today. Who are they? Where do they want to go? And we go from there.
Got it. No, that's all fantastic and wonderful insights, Philip. Thanks for sharing that. So my DMs, QA window, the chat window are all blowing up. So we'll jump to the Q&A section. And just reading the first question here. I think you've actually covered most of it, both of you, but I'll still share the question, and if there's anything that you kind of missed, you can share that. So on the Q&A window from Gaston, what makes a founder exceptional? Is intuition an important factor in your strategies, and how do you apply it?
I guess I can piggyback off my prior answer here. What makes an exceptional founder is a great question. There's of course the sort of stories of the Zuckerbergs that are dropouts that at 19, 20 have an exceptional handle on what they want to build and they can execute on it. Those are obviously the remarkably rare use cases for that example. The exceptions rather than the rule for us. We certainly want to focus on founders that have done it before, that have repeat experience, whether it be in their industry or operating and running startups. Prior exits is obviously the cherry on top. That sort of demonstrates an ability to not only create and build and scale, but also understand when the right time to sell is the right time. I think many times founders get a bit, naive or overly excited at what they've built and perhaps hold on too long. From the VC perspective, I can empathize with why you'd want to do that from a founder's perspective, but from a VC perspective, sometimes, knowing when to sell is probably one of the hardest things you can do and master. Sometimes for me, when I'm on founder conversations calls, it's very easy to see when someone is completely obsessed with the problem they're solving. When a founder comes to me and tells me that they've done on the ground market research and validation of the product, I get excited. When you can tell that their brain's already thinking about what they're building during the conversation, I get excited. I think, exceptional talent has demonstrated exceptional work beforehand and is willing to put the effort that it takes to, take a company to, 0 to 100, which is a lot more work than anyone really can expect.
Wonderful.
And really quickly on the intuition part of the question, absolutely, it plays a part in it. Obviously, you can look at all the numbers you want, but VC as an asset class is remarkably risky. I think 90% of investments go to zero. So there is a large degree of leeway you can employ to say, hey, I have conviction in this. I believe in this. I'm removing the emotional bias I may have based on prior relationship, and really letting that guide you based on, a holistic thesis of strong founder, great TAM, et cetera, et cetera. I think intuition certainly guides me, guides some of our folks at Gangels, but it's something you shouldn't shy away from, because as you develop that instinct, you'll just become a better investor.
Wonderful. Brian?
Yeah, happy to piggyback. I definitely agree with everything Philip is saying, kind of echoing some of that. In regards to intuition, I as well feel like especially at the seed stage when you're so early, intuition is definitely an important part, and part of our jobs is pattern matching to some degree. So looking at past successes and companies that have been exceptionally successful in the past, and why that is, and if we're able to find companies that are exhibiting similar types of traits and founders that are exhibiting similar types of traits as well, always definitely helpful. I think another part of intuition as well is also just market knowledge, especially if you're a little bit more of a specialist within an industry. So, for example, some of our partners are very specifically focused on cybersecurity and application to federal marketplaces. So definitely when they see technology that they either know will fill a unmet need within the federal government, or a technology that is going to be solving a problem, or potentially if there is some type of legislative or executive order that's going to be coming out as well, and there's a technology in front of us that a founder is presenting that would be helpful to fill those unmet needs. I think that's another strong part of intuition, and just again the feeling that something might be the right solution for a host of problems. So definitely think that intuition does play a role in the process, but certain elements of intuition, I think, as well are helpful. And then as well, to piggyback a little bit on Philip's answer to what makes a founder exceptional, I think some things that we've found, and I touched on them a little bit, kind of the hacker and the hustler element within a founding team that's important to us and makes founders exceptional. But as well, again, that industry expertise from a long tenure within, in our case, cybersecurity, but then kind of more of the qualitative aspects of a founder, definitely knowledgeable, smart, hardworking, willing to put in the hours, burn the midnight oil, in addition to, also being coachable. Something that we find a lot is that, founders obviously do a lot of work and the company is their baby, but wanting to make sure that not one person is going to have the answers to everything, and being able to listen to their board of directors when a problem does come up, because there are always problems and challenges within startup environments, and being able to kind of look around the room and understand which one of the board members might have the most relevant experience, being able to allow for them to mentor and provide guidance as well is super important for us. And I think that that's definitely an element of a very successful founder who will generate strong returns for portfolio firms.
Got it. Just going on to the rest of the questions. This next one, if it's confidential, just feel free to say pass, but it's asked, so I'll present it from Sarita. Which rating agencies are your SPVs rated by? And feel free to pass.
I'm not even going to pass. I'm just going to say that, at least from the angel side of the business, they have their own third-party provider for those rating services. But I myself have never really engaged with ratings for SPVs, so I can't give you a real answer. I'm sorry.
Right. Brian?
And unfortunately for us, we don't really do SPVs at all. So I'm not able to provide an answer either now, because it's confidential, but just again, lack of experience there.
No worries. All right. Last question from Gaston. And we'll finish with this question. So this will be the last one. Which industry would you say the unicorns are coming from at the moment?
Yeah, I think we've seen a lot of hype around AI, as Philip was mentioning earlier. I've definitely seen OpenAI get acquired for large amounts as well, even at a very early stage. So I think we're seeing a lot of traction in again, new technology, how it's being applied to existing data sets, how it's being utilized to either make people or processes more efficient, to save on the cost side of the house, or if there's ways that technology is being able to use again with data sets to help drive revenue for companies, right? I think those are kind of the two areas that we're seeing as being kind of the up and comers outside of cybersecurity. Obviously, since we're a little bit biased on our side, but I think those are kind of the two strong areas that we're seeing a lot of traction in for driving unicorn growth. Even though again we haven't seen too much on the unicorn development side as compared to 2-3 years ago. I think on the flip side of things, from a unicorn perspective, and what companies are struggling, we kind of want to stay away from more of the consumer cyclical side of things. Anything that you would see within kind of the stock market,
Yeah, piggybacking off of Brian's answer, I think he's absolutely correct. We've certainly seen a multiplication of value in businesses that focus on enterprise SaaS optimization and enablement, whether that be through data, human performance, anything that just makes an enterprise run better is very valuable for those folks. Where it moves from I want this to I need this. To us, a unicorn is derived from that fundamental need for a product, which becomes instantaneously sticky from the consumer side, and they're able to kind of really easily scale up from there. From Gagel's perspective, we've seen some moderate success in consumer wearables. Again, that's like data optimization and tracking, so akin to other stuff we're doing on the enterprise side. We've sort of seen a cool down in the biotech space as well, which is kind of perhaps expected based on the kind of folly evaluations we had in 2021. Fintech as well, there's definitely been a depression in those. There was massive unicorns there. If anyone remembers Stripe, Revolut, those companies that in 2021 were at that $80 to $100 billion mark, those are now at the $10-15 billion mark. So we're actually very curious to see what happens with what has seemed to be an opening of the IPO market. I know we saw folks like Instacart and Arm raise at above expectation valuations, but yeah, fingers crossed. Exactly, Ike. That's at the very least the start of IPOs happening. I mean, there was basically almost zero in 2022. So that'll be a curious data point to follow as we move into the new year of what's actually happening and how people are assessing the IPO liquidity market. But yeah, fundamentally, Brian's absolutely right. I think we're seeing the most value being generated by enterprise SaaS solutions that offer whether it be data security, data optimization, or just data scale and enablement. That's kind of where the excitement sort of goes.
Wonderful, wonderful. Well, with that, we'll wrap up the panel part of the discussion. Brian, Philip, thank you so much for taking the time today, sharing those wonderful insights. I know I learned a lot, and good to see the differences between not just the two of you, but kind of how the two of you even differ in some cases from the broader angel investment industry. We still have a lot more questions. If you both of you want to jump on the Q&A window, there are a lot of good questions being asked about what's a good time to start talking to investors for an early stage digital product, to companies which has maybe not a 700K ARR, but maybe much smaller. Kind of what's a good time for them to reach out, and what are some of the factors you look at. Feel free to kind of type the answers in and address those questions. And then at the same time, if you want to also put your contact information in the webinar chat window, that would be very helpful for our audience and the guest members to reach out to you. Feel free to please stick around. We do have 6 fantastic portfolio companies that will be pitching, so would love to get your thoughts on them, Brian and Philip. With that, we will now move to the start of the pitches part of the presentation. I know they're coming to us today from around the world, from the Middle East, British Columbia, Canada, domestically from San Francisco, New York. And so good luck to all the folks pitching today. And thank you so much again for Brian, Philip, and everyone for taking the time today. Ekant, back over to you.
Great discussion, guys.